Hey everyone, welcome to the KE Report, a daily editorial recorded on April 14th, Monday. Boy, oh boy, last week was such a crazy volatile week that now chatting with TG Watkins, director of stocks at Simpler Trading and editor of the Profit Pilot website. This is a great chance to touch base with TG and get a feeling of how he is trading these markets from more of the short-term perspective. That's all I keep hearing about is the opportunities in these markets if you're a trader to trade the short-term volatility. That being said, there's a lot of risk involved with short-term trading, especially in these volatile markets, but a lot of opportunity too. So, TG, make sense of these markets and this volatility. What are you doing?
Yeah, there's been a lot, hasn't there? Let me just first say that we actually started buying either ETFs or some stock positions, and we actually put on a longer dated SPX put credit spread on Wednesday morning because the technicals lined up. Basically, the charts were telling me what we wanted to do based on the Moxie patterns and all that. And then about 2.5 hours later, Trump came out with the 90-day tariff pause news, and of course, the market just skyrocketed. But the amazing thing was, it was because of the technicals that we were actually in already that morning before the news came out, and we were already well positioned. So once that happened, we actually jumped on a couple other things and then ran for it. So things have been pretty good. We've been doing a combination of swing trading, like kind of multi-day trading, and also some zero DT stuff. Like about 10 minutes ago, I just put on a zero DTE position because I see like right here, right now, I think that the market is bear flagging. Again, just day trading, so I see that so far it's working out, and we'll see how this continues as we stay live on the mic.
Well, TG, maybe put a little more color around, when you're looking at these different indicators, your Moxie indicator and other indicators that you use to be in position before the moves. Talk about the idea that I hear all the time that technical analysis does not predict the future, but it does show you when there's favorable risk reward setups and when you want to get positioned. So it's not a fortune telling device, but it is a way of understanding what the risk reward is. Maybe unpack that a little bit more.
Yeah, well, I have certain patterns, and I do think people look at technicals and look at these levels, look at moving averages, look at their certain indicators. And basically, what you're trying to do is figure out when something is either overbought or oversold, and then you can play the turns, or you're looking for continuation. And that's really what we can do. That's why part of the reason we went long on Wednesday is because, well, basically, you can also line it up with a little bit of news, some technicals and the news. We had a double bottom. And then if you guys remember Wednesday, just to put everybody's mind here, it was April 9th. And remember that on April 8th, that at midnight, the extra China tariff had been instituted. And so that was another thing. Oh my God, more tariffs. And so you think, okay, well, is the market going to go down even further, get crunched because of this? Well, when you could see in the overnight that the market really didn't go down, and when the market opened on the 9th, basically pretty solid. Didn't go down any lower. And you're thinking, oh, they even added more tariffs, but the market did not go down. Well, then, gee, maybe the market's fine with where it's at, and this extra tariff news doesn't matter. And so that's where, from a technical standpoint and just market behavior based on some news or a lack of effect of that news, I said I think the market's fine with this, and it's already priced in this stuff, and we're probably going to go higher. Lo and behold, the news came out that the tariff pause came out and then just added fuel to the fire of what we were kind of already seeing about market behavior.
TG, how are you using these zero-day options then? Because we keep hearing about zero-day options. Yes, they're risky, but boy, oh boy, they can provide some huge gains if you're on the right side of that trade. How do you trade them, and do you hedge your bets at all when you are taking these short-term bets?
Yeah, well, basically there are two different ways that I do this. Either you can sell premium because if you're going to be selling premium, the idea is that they're zero DT, they basically expire every day worthless. And so if you're just on the correct side of that, then you can do that. You just want them to go down to zero or near zero. You can also just say, hey, I'm just trying to catch a move, and maybe you don't want these things to go to zero, but you can easily in a market like this that's moving so fast, you can make 50, 60% in a matter of minutes because if the market moves away from a position, then the premium in these things basically disintegrates. And I can make 60% in 20 minutes if the market actually moves pretty nicely. Now, on the other side of it, if you're buying, then when you get these bigger moves and the market keeps going in the direction that you bought, whether it's a put or call, These zero DTs, once the market starts getting into the money of that strike, yeah, they can really start ballooning. That they each of them have their personalities. You know, if you're going to be long of any of these things as far as buying puts or buying calls, you need the market to continue moving in that direction, and you kind of need some bigger moves to offset that theta that is making these things go to zero each day. So it could be a little bit tricky. They move a lot. So if you guys are interested, I mean, this is where I actually just taught a class about zero DT using the Moxie indicator and all my methodology and principles about that. So we just recorded that, but it's still active if you guys are interested in coming check it out. And then we actually have the third part of this class series, which is this Wednesday, and it's going to be based on ETFs and leveraged ETFs because those things I've noticed over the years that they actually show some things that most stocks or other just regular ETFs don't show. And I think it really says something, the fact that, we've now had an explosion of these leveraged single stock ETFs. So clearly they're important and clearly people are picking up and paying attention to them. So I've found some things about them too, and we're going to be teaching that. So if you guys are interested, go to simplertrading.com/Moxie and you'll start to find information about that. But yeah, there's lots to do about the zero DT. It is challenging, but it can be very interesting. So if you're the kind of people who like to do day trading and actually like the action and movement of the markets each day, I figured out some ways and kind of talk about this stuff and show it, and there are opportunities. So you just kind of have to be prepared for kind of being in the Wild West as far as the movement that these things have.
Yeah, the volatility can be extreme in some of those zero-dated options, or even in those extreme ETFs where they're 2x, 3x, 4x on a single stock, or even on a sector. So nice to have some principles and strategies around it. Recommend people checking out TG's classes on that. But for people that don't trade options or don't trade the leveraged ETFs, there's still a lot of volatility just in individual stocks. Are there any individual companies or trade setups that you see that you'd like to highlight for people listening in?
Yeah, actually, what I've kind of learned in my experience from 2022, still being pretty fresh, is that when the market gets into a situation like this, I think that we need to understand that for the most part, small and maybe mid caps are not going to be really the place. Those things, especially small caps, need a certain environment to really shine. And when there's uncertainty, they don't really shine very well. And so even though the market might move up or might move down, the small caps might be pretty muted. So like right now, I think the market has bounced or bottomed from last week, and I do think we're going to start trending upward. But I'm not really looking at the small caps because I'm not trying. I don't think that they are always net. I don't think they're going to be reliable as far as the patterns and the setups and the kind of moves that I want to see from them. So what I'm doing is if I think the market's going to go up, I'm trading the bigger, more popular stocks that I think that bigger money is in, and I can better rely on where those things are going to go. So I am trading the FANG stocks. You can look at Palantir, Tesla, you can trade all these kind of things, and you can trade the ETFs of these things. And that's how I'm tracking the market a little bit better and sticking to just a handful of names because I don't want to have 15 positions on when basically news could come out and change something, and now I got to literally just go through and click 15 buttons, all at once, and it's kind of difficult. So I'm really kind of focusing on a smaller stuff since the market's in turmoil.
Interesting. I think that's a very good comment, and it all ties into this uncertainty that we have in the market. And you are right, the smaller stocks, they really don't like uncertainty a lot of the time because they need people to be confident, be bullish broadly on that environment. Do you find yourself, though, if you are looking at these bigger stocks, trading with a bias either to the upside or the downside, and maybe a bigger picture if we want to classify it, bull market versus bear market?
Yes, absolutely. In fact, I just had some of our subscriber traders ask me about that because they're saying, "Hey, do you ever do iron condors?" And that's basically where you're selling above and selling below because you think the market's going to go sideways. And I said, I don't really like those because for the most part, oftentimes the market moves. It doesn't always stay perfectly flat. And so I rather just pick a direction. And so yes, when I come in each day or each week, kind of whatever I think we're going on, I do have a direction. I do have a primary thing of where I think the market's going to go, and I want to either sell against that or I want to buy with it. And like this morning, actually continuing from last week into this morning, I figured that the market was still looking good. We did have some good news over the weekend about some tech products and semiconductors being exempted from the latest China tariffs. And so that added a little bit of a bump up here. But again, technicals, we were a little stretched this morning. We ran into the daily 21. And I'm kind of looking at things. I'm like, we've had a really nice move off of the low from Wednesday. And I wouldn't be surprised if we started running into resistance and we actually start pulling back to test support. And so that's what I think is happening right now. From this morning gap up, we ran in right into the top of that giant 10% Wednesday move. And I think it's acting as resistance, not to mention, as I said, we gapped up. And so I think we're fading back down. And I'm kind of leaning towards this week looking for a bit of a pullback because I think if that happens, then if we test support, I actually think we'll go higher from there. I do think that the market has bottomed for now, and I do think we're going higher. I'm kind of looking for the S&P to get up towards its daily 50 SMA. That might be around 5,700, maybe on the high side we can go to 5,800. I think it's going to take some time. Of course, it's not going to be a straight path. And I'm actually looking for price to come down to test support before we actually go up like that. And so that's how I kind of position myself and be prepared for where we're going kind of each day for the greater picture.
Okay, so you're looking for some of these things to maybe pull back a little bit to support, then you buy them there, but with the anticipation that in the medium term they're still going to be going higher along with the S&P. What do you do when levels get smashed? Meaning, like when we saw some of the action over the last 2 weeks, we really haven't talked to you in the crazy volatility we saw. So when support levels get smashed to the downside, or when things springboard back, like we saw, that Wednesday trading where the stocks are up the most they'd been in 24 years and they blast through resistance. How do you account? I mean, do you just ratchet down to the next level of support and resistance levels? How do you deal with it when levels get smashed?
Well, number one, if I am not prepared for it or something, I'll go to cash. I'll exit my position, be like, wow, I wasn't surprised. I wasn't expecting that, or I don't know what the market's doing, or I'm just not prepared for this. And I go flat because if I'm going to be a trader, not an investor, then I can just go to cash and say, you know what? I just don't know what's happening here. I can't recognize it and I don't have an edge. That's great. But if we back up and we look at when the market made its first 10% correction, this is back here in March, we got a double bottom, and I did trade that in through there. But then, basically, coming off of that second bottom, the double bottom, we did drift up, and then we had the whole Liberation Day, Trump coming out with tariffs. And there were two directions that I thought the market could go. One, because we're at a double bottom, maybe the tariffs were priced in, and maybe Trump is going to come out and say, yeah, a lot of negotiations happened, we're okay, and we'll kind of see where this goes. And so I could see the market going up from that double bottom from there. Or if he came out and doubled down and things were going to be harder and stiffer and worse and all that kind of stuff, which they were, the market had not priced that in, and that because the tariffs are bigger, that is why the market then went down another 10%. And honestly, I was in cash for that. I just said, look, this, I don't know what's going to happen. This is a big news event. I could see it going either direction, and I'm going to wait until that direction is picked. And so then when we got the news and the market had not priced in the tariff stuff, it went down. I was day trading through that. Now, cool, it would have been nice if I had just picked a swing short direction and it would have gone down another 10%, and that would have been great. But when we get volatility like this kind of stuff, I'm like, I just switched to day trading or very, very short-term trading. And then the next area is, after 3 or 4 days of straight down, especially with a gap down on a Monday, I thought, okay, that's probably enough. Kind of like what we saw 2 weeks ago. And same thing, it was. The market started to find support. It got oversold. It went down 20%, which is another typical level for, hey, everybody knows, buy at 20% correction, that kind of thing. And then we started to bounce around again with the whole China tariff news that came out last Wednesday. Market didn't go down. I'm like, okay, I think this is the bottom. And so we started loading up to the long side. In fact, we went longer. So that's what I do. If you got an edge, great, play it. If you don't, go to cash.
Is there any way to trade volatility? Right now, volatility is very expensive, but it seems to be this overarching theme that we're going to continue to have very volatile markets because of who knows what's going to happen with tariffs and even what other countries are going to do. So, is there a way that you have to trade volatility as long as it sticks around that everyone's expecting?
Yeah, well, I mean, if you're just saying, hey, trade volatility and the fact that the market's moving, then yes, basically day trading or very short-term trading. There's lots of movement, which means there's lots of opportunity if you can find your spots. If this doesn't work for you, then don't do it. Volatility might be the worst thing for you. If you are even a longer term trader and you see the market came down to 20% correction and it hit all sorts of support levels and this and that and whatever, and you're looking at your breadth indicators and you're looking at the VIX and you're like, wow, these are extreme areas. We're probably going to turn around and I think we're going to do it for a few weeks. Then great. Maybe you're a longer term dip buyer and maybe you bought sometime last week and now you're just riding this up because you think we're going to go higher overall for the next few weeks. Great, you can do that too. You just have to wait for your kind of setup to show up, whether that's day trading or whether that's a longer term thing. And I'm looking at some stuff. I'm like, yeah, the market just pulled back 20%. Breadth got smashed. The VIX went up to, I don't know, 55 or 60 or something like that. This usually doesn't sustain. And so I think people were starting to come in and be like, I'm just going to buy the dip. And then, of course, then we come out with Trump coming out with the 90-day tariff pause, and like, boom, there you go. That's the confirmation that we're looking for. And now the longer term swing traders can get back into the game for now because most likely we're probably going to go higher for a little bit longer, even if there's some news in between. I think that the market is so oversold. We got some good news, and I think the market's going to drift higher for now. Now, to clarify on that, because I think a lot of people are saying, like, buy the dip. Where I've been saying is, yes, buy the dip, but maybe don't hold the dip. I'm not entirely positive that this is a great spot for a longer term trader. I think it's fine for maybe a medium term because I do think we still have some volatility. I do think we're going to have some more stuff come out. I think Trump and his team are still going to be battling the economic war and all that. And so I just think that this is a middle spot where we're probably going to bounce for a while, but we could still see some weakness after this, or at least I don't know yet. And that's why I'm saying I'm willing to trade from here to there, but not say I'm buying and holding here for the next year or two.
TJ, I really like that line. Buy the dip, but don't hold the dip. But that brings up the next question, which is, I mean, a lot of people, when they buy the dip, they perpetually hold. And even if they're buying the dip, they're just adding to a position they've had for a long time. When do you sell? At what point do you sell out of the dip that you bought?
Well, that's where it comes down to you need to understand what kind of trader you are and what your time frame is. Because if you kind of use 2022 as an example, there were lots of dips, weren't there? But the market kept going lower until we finally turned around. And what I've been trying to tell people is I think this is just one of those dips. Now, I don't know if we're going to go lower, forever or how long, or maybe we just go sideways and all that kind of stuff. But I just don't think that this is over yet. There's a pause. They want to do a lot of things. And I just don't think that the uncertainty is over yet. So I don't really see that the market is in a condition where we went down 20%, we can buy the dip, and we're going to be back into a bull market because it's just the narrative hasn't changed yet. They are actively trying to do the economic war type situation. We know that they are trying to shrink the government. We know that they're trying to get our debt and everything else back in order. This is not a time where the market is super happy and it's like, oh, 20%, cool, let's go higher, in perpetuity. No, this is a technical, we hit a 20% dip, some pause, like not even good news. It was a pause that came out. And so now we're getting kind of a technical bounce. I just nothing has changed as far as the longer term. And so I think if you're a longer term trader, you need to wait for kind of more to work itself out because I think there's more stuff that needs to get worked out of both the economy, the news, and the market.
All right, TG, let's look at a couple individual sectors that we like to ask you about. You know how much our audience likes the precious metals market. Boy, oh boy, gold has remained very strong. It's been the best protector during this market pullback. Also, gold stocks, they had a pullback last week and then rebounded so quickly. Any insights on, let's say, GLD or GDX, how you would trade those?
Yeah, it's been pretty wild. In fact, so I like to trade leveraged ETFs, and so we've been trading GDXU and GDXD. In fact, we made 28% up on GDXU a few weeks ago, and then we traded the downside, so we bought GDXD and we got 22% out of that in one day. Now, I did miss this up move on GDX, this latest one, partly because I had to go take a trip and partly because, I mean, the snapback was so fast. I was like, whoa, okay. And so at this point, I do think that gold and GDX are extended. Obviously, they're doing great, but they're extended. And so what I'm doing is I'm being patient. I'm looking for a pullback, and then I'm actually looking to buy that pullback. So yes, I'm still bullish on it. I'm looking for a way in. I don't want to go buy it up here when it's straight up. Let's give it a day, two or three, or how long it takes for it to come back down a little bit. I'll have it verify that it's found some support, and then I'll start buying into it. And that's how I can, miss the first move, but I can get the second move. Basically, gold going up is a hedge against all the things that are happening right now. The uncertainty, inflation possibly, or the bond situation. It's basically, this is the biggest flight to safety that people are looking at, and it's gold. And so that's why gold is doing well. Gold miners can also do pretty well in this environment, which we've been seeing. But do remember, if the market really does get into a pickle or a bearish situation, GDX is still just a bunch of stocks. Okay, they are related to gold, but they are not gold. They are still companies, and if people need to liquidate and sell things, they will sell whatever they need in order to maintain their margin call. And so you just have to understand that that is the difference between GDX and GLD.
Well, let's talk about one other difference, and that's silver versus gold. Silver is really a messy whipsaw chart, and the silver stocks, if you use something like a popular ETF is SIL or SILJ, I don't know if you have any thoughts on that when you look at it, but it's such a messier chart compared to gold. It's not a clear breakout. How are you looking at something like silver or the silver stocks?
I will tell you what I understand about it and what I've had to learn over the time. I really don't trade it, mostly because everyone I've always talked to is don't trade silver. It's a bit of a widow maker. And then also that silver is not necessarily a flight to safety like gold. It's more of an industrial metal. And so I think even though it might go up, I think part of the reason why it's having troubles is because it's this push-pull between, oh, it's a precious metal, but also it could be reflective of industry. And so if we are trying to shrink the government or not shrink the economy, but we're going to have to go through some transition and we're doing a trade war and a bunch of these other things which are affecting the economy, then silver as an industrial could be affected. So I think that's why it's so choppy and still kind of neutral is because it's like, oh, precious metal, but also industrial. And so yeah, I don't know. I would be careful with it because I do think it's going to go higher, but man, it is a tough one to go higher. Like pick an easier vehicle, pick GDX, pick GLD. I don't know, find something else that works a little bit better like that.
Kind of to your point, stick to the bigger stocks, stick to the bigger sectors, right? Silver is, in a way, kind of like the small cap in the precious metals. So maybe that ties into it too. But hey, TG, very interesting chatting with you. I think right now, out of any time, is the time to be a short-term trader. Boy, oh boy, that volatility is still around. Who knows? Maybe this week will be a little bit more calm, but hard to beat the volatility of last week. So thanks for your insights, and please send me the link so I can share that within the show notes so people can tune in to some of those classes that you've been teaching, maybe hit some of those recordings. TG, as always, thank you for your time today.
Great, thanks, guys.